And I've never really kind of taken long-term positions, but obviously traveling around, you have to take that slightly longer-term view. It's been quite interesting to adapt your trading style, just to kind of take out that volatility, especially over the kind of summer months where it was, incredibly difficult to pick tops and bottoms. And now we're moving into this new era, the Trump era, the era of interest rates going back up. I have to sit here quite smugly, because if anybody who's listened to me for any amount of time, I have told you this, that there's no way on earth that Mark Carney could keep interest rates low until 2017 to 2019. And that's regardless of Brexit, whatever. It's just time. Mark Carney was brought in to do a job. He hasn't done it. His only answer to everything has been to cut rates. We've traditionally followed the Fed for forever. So as the Fed started to raise rates, it was absolutely inevitable that the UK would have to bear the brunt and get involved as well. It's not necessarily a bad thing that we've seen such a dramatic currency drop in the short term, due to the fear around Brexit. But we're not a manufacturing nation. We're not like Germany. Our output isn't that big. So we're always going to have to rely on services, and a normalized interest rate would help balance that drop in sterling, and that's going to come. So I'm going to walk you through a couple of pairs, especially, funnily enough, the New Zealand dollar, which I've been tracking for a while against the pound and against the US dollar. I'm going to kind of give some ideas of where I think the markets are going to go in this. And it's not a new era, but it's a new era in modern trading. I've said for a long time that we've had to balance this idea between looking at the markets technically and looking at the markets fundamentally. This is technical. Okay, so everything you see here, every line is drawn on highs, lows, pivot points, Fibonacci especially, and that is just technical movement. But the markets are built up of ideas, of people's medium, long-term views, and that's all built into the markets, and that's exactly what we're trying to figure out, what these technical views are going to look like to the right of the screen. Because it's all very well saying that, the euro is going to drop here, but the money's made to the right of the screen. Everything to the left is what could have been. Yeah. Oh, I knew that was going to happen. We don't make money that way. So the idea now that we've been focusing so heavily on this stimulus, this extraordinary monetary policy that all central banks have done, and where's it got us? Well, I mean, we haven't had, in air quotes, a crash, but things haven't really returned to what we wanted. The growth levels have certainly disappointed. The sustainability of growth has been underpinned by borrowing. So all this idea that putting interest rates up, we've held off for any other reason that people are overburdened with debt is nonsense. You have to normalize interest rates every 7 years or so. There's a natural market correction. It's been over 10 years now. We haven't seen a correction, sustained correction in the stocks, and that's because it's propped up by the 1%ers, the people that don't feel pain. Okay, so until Donald Trump and his pals at Goldman Sachs decide that they want to dump the stocks and get out, markets will keep going higher. Pretty much, I would say, hand on heart, 99%, me included, percent of traders out there have been burnt by trying to sell highs in the stocks. So the stocks naturally will correct, and invariably, I'm sure most of us will miss it. And that's just the way trading goes. But still, we're in this very bullish circle and cycle in the markets where we've been conned into thinking that the growth is good, that the euro area is suddenly fixed, it's completely stable, best figures ever. They're all best figures in short-term comparables. In long-term comparables, they're still pretty dismal. So what do we all think when interest rates are going to go up? We stop focusing on the growth figures because they don't matter. But we've kind of skipped a point in that. The inflation figures, which we've gone back to and say, oh, inflation is too high. We've made inflation figures up, really. Or we've really not tracked them closely enough, because at the end of the day, all the growth that's been happening, it's been false growth. It's been stimulation from the government, and now the government have kind of ignored inflation. And the only way you can control inflation with interest rates is they're being forced to put interest rates up to control inflation that they didn't control in the first place. If you kind of catch my drift and you see my meaning. So we're kind of chasing figures that don't truly exist. So when we start to unwind the balance sheet and all the QE and all this, extraordinary policy measures to stop a crash happening, what's going to happen when interest rates go up is that the government, central banks have led by example. They've racked up huge debt on very low interest rates. What's going to happen is all the people that have borrowed to stay in their lives and to create this false growth are going to have to pay it back. So that's anybody who's bought a house in the last 5-10 years, especially in London. Yeah, all those nice rebates coming back, all those nice cuts in your mortgage rate, they're all gone. They're going to go up. If you talk about people in central London, £500,000, £1,000,000, £2 million mortgages based on low, slow wage growth, even in a 0.25% rise, and even if it is as gradual as Mark Carney is desperately trying to convince us, yeah, it's going to hurt people. So it's going to hurt the midpoint, and it's going to hurt the low point of the market. Not the ultra rich, the 1%, the 5%, 10%, whatever, because they're bulletproof. It's going to hurt people that are earning and are borrowed to sustain or try and improve their standard of living. So this is where it comes back into the markets, and we say to ourselves, all right, Steve, that's great. So interest rates are coming, we know. Fed have signaled probably one more this year and 3 more next year. So what's happened? People have carried on buying the dollar. Now, if you look at the dollar kind of longer term, again, it highlights, probably just the weekly, what was kind of expected. We're expecting, okay, the interest rates to kind of come in, and they did. But the money, as I said, was to be made down here, speculating before interest rates announcements or are priced in or confirmed. That's the end of the process. So what the market does, it comes in, buy it up, that's great, and then it starts to go down at a time you think it would go back up. Because it's like, well, there's going to be more interest rates than we thought, or at least what the Fed have said, and then there's going to be more next year. But the market then sells down. So we're in this point now of where do we go? Do we go back to these levels I've highlighted, talked about a million times, 117, 121, or 124 against the Japanese yen? The Japanese yen is always a good one to compare the dollar against because it's so heavily invested. There's a strong correlation going back to the date of when the earliest really hedging, trading, kind of betting currencies against each other really began. So they're intrinsically linked. So the idea is, really, we only really have to break 114 again, and then we think that the dollar's back king. Whereas, what do you think about, your global investors, your people, your 1%ers, your corporations, where are they going to feel safe? Even though Donald Trump is, I don't know. I don't even know where to start with Donald Trump. I'm not going to go into that kind of political side. He is what he is. And even if there is some sort of altercation with North Korea, then what does it matter? What are people going to do? Pile into euros, pile into the pound? It doesn't matter. There's no world left and nothing matters anyway. So the whole point is with this relationship now, it's not necessarily about what Donald Trump is, what he's going to do, what Korea is going to do. The world doesn't seem to care about that anymore because, again, the people that really control the markets will all probably be pretty safe. So at the end of the day, this is getting back to interest rates. Yep. So the market had seen the growth figures, not so good, had seen the job figures, knew that Trump was not a fan of Yellen, thought Yellen could go, and then all of a sudden, Yellen's gone, no, we're going to stay, keeping to the plan that the Fed have meticulously kind of tried to stick to for the last decade. Another hike in 2017, bang, probably 3 more hikes in 2018. So again, these are your targets on the upside. There doesn't really seem to be anything the US can do, from raising its debt level to Donald Trump, to the riots, to North Korea, to anything, to make me think that the dollar is not going to remain the currency of choice. So every low point on this chart, and again, flick through to your dailies, is going to be an option to buy. Again, I'm not a long-term trader, but look, all these green days, a little bit of profit taking, a little bit of profit taking, may not be the time to buy now. So if you want to buy the dollar, buy it low. Where's value? I don't know, look for the last Fibonacci to try and find some balance points. So on the downside, yeah, the market always retraces to a 50%. Well, I say always, 80% of the time. So from this high to this low, no high or low has been made so far. So the market is going to retrace to 50%, 38.2, 23.6, 50%. Now you tell me, is that a decision point on that 50%? Yes, it is. So the market breaks the 61.8. We might take a breather up at these high levels. Bit of short-term pivot resistance here. Maybe we get down to the 61.8. Maybe we get down back to the 50%, 111. Yeah. So if you want to buy it, buy low. Yeah. Because what people always forget is this whole philosophy of trading. If you want to be selling it, you want to be selling it when it's the greenest it's been. So here, and then it turns red. You want to buy it the reddest it's been. So you said here, because when this is red here, it doesn't close till here. So when you're long, green, green, green. Bit of profit taking, think about it. Interest rate, yeah. US is carrying on, green, gap, green, 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 green. So it's all, it's trying to look at it on its head. So I would never be buying the dollar here because there's absolutely no value. There's no value in buying the dollar here, but there might be value buying the dollar here for a bounce. And again, if you go back to your hourly charts, that's what we're trying to tell you. You're looking at your different views, your monthly, weekly, daily, and you're trading intraday on your hourlies and your 15s. So again, 50% pivot, we break through resistance up here. The 50% has been a perfect target. So we're slightly above it now. So today, look for bounces around the 50%, short-term squeezes, anywhere down to the 61.8 that we've drawn. And look on the hourly configuration for the market to find support on these lines and go on to make a new intraday high. Because this is live, this is intraday now. Yeah, when you look on your dailies, that day's closed, it's gone, it's in the past. So green day, green day, green day. This might absolutely turn into a green day. Yeah, but if you want to be buying it, you want to be buying it lower, waiting for it to turn, from red to green. And again, I just want to show that on a kind of more balanced scale. If you're trying to trade intraday, then this is exactly the kind of setup that you're looking for. Yeah, daily, hourly, 15-minute, 5 minutes. So if you want to buy the dollar, well, in relative terms on the daily, okay, we are a little bit low, sorry, on the hourly. On the daily, it's all a little bit, high, but we've come down for 2 hours. Yeah, missed the 50% and the moving average here. But then look, all these 15-minute reds, yeah, rejected the Bollinger Band and the lower 161.8 on the fib are inside. So short term, and it might not be the making of your trading career, but you could easily buy another 80 pips back to this 100% retracement on the 15. It all depends where you see value. You see the charts on the daily building up. You break them down through the charts that are moving, the hourly, 15 and 5. So again, short-term trading is certainly on these term charts here, a little bit longer on the hours and longer still on the daily. But your entry points all revolve around the time frame that you're looking for. Okay, so it's just something to bear in mind. So let's just take that back to the hourly. So I think it's very, difficult from a technical perspective or fundamental perspective to see why you wouldn't buy the dollar. I don't think that anything could really happen that's going to make people, well, that already hasn't happened, hate the dollar or America any more than they could. So it really is, looking from a no emotional side, no matter how you feel politically or ethically or anything. The US seems to be able to do whatever it wants and still get away with it, and that's pretty much, it's proven in the markets, especially for the dollar. So other markets that are related to the dollar, I guess we can look at the euro dollar. Now the euro dollar, on the back of that Janet Yellen saying about interest rates, has taken a hit, and it has been considerably stronger than I thought over the last few months. And that again is down to not really the interest rates, because there's no chance that Mario Draghi's going to put interest rates up, as soon as the UK are. But it's a reflection of dollar strength equals pound weakness equals euro weakness. But as I've said for quite a while, really the pound against the dollar and the euro against the dollar is more of a bet around Brexit and who the winner is going to be, because this is interest rates speaking here. This is purely US interest rates against the world, okay? Because Japan are out doing their own things. Japan are quietly fading into insignificance on a global scale, in my opinion. But that's, again, it's trying not to be personal. At the end of the day, dollar strength really for me in interest rate terms and currency terms is really reflected in the dollar yen. But the kind of pound strength against the dollar and the euro against the dollar is more a Brexit battle. So it's when the Brexit gloves are off and we've finally paid the amount we want, and the European Union have got the pound of flesh. It's where do we go from that, and what does the world, more importantly, go after that? When do they start to buy the pound against the dollar and the euro against the dollar? Because they've done that against the euro already. I mean, if you look on the weekly scale, we were looking at these levels down at 1.10, 1.11. These were kind of points where the euro should really have ebbed out and gone made to new lows. Really, a lot of people were talking parity to it for a long time, as was I, and that should have happened. But it seems that the Brexit perception in the world is that Europe's bigger, Europe's stronger, Europe's better. All of a sudden, because Theresa May lost the election, England's bad. England's, bad Boris Johnson again. It's not, the sensible old ruler of the planet type thing. So obviously, whatever, maybe it's relatively short-term speculation, but the euro's crept up and it's dramatically, kind of bought up levels now. So the idea that, we're kind of high because the euro's worth what it's worth is a bit of a false promise to me. It's more that the euro's up at these high levels because it's risk off the pound, and people that are heavily involved in the dollar don't have anywhere else to go. As I've just mentioned, the problems with the yen. There's other currencies, but the Swiss franc, has had its day when now it's not pegged against the euro. These other kind of, in air quotes, safe haven currencies just don't have the volumes anymore to cope with the amount of exposure that people have. So the euro has been somewhere that the large corporations, large investors, put cash in the short, medium term, getting out of pound to diversify the risk. But at the end of the day, as everybody probably sees the Brexit negotiations, it's lose-lose for the UK and the European Union. The European Union's gain isn't necessarily the UK's loss, and the UK's loss isn't necessarily the European Union's gain. So this idea that the euro is going to stay high off the back of Brexit is nonsense. At the end of the day, the UK has real problems with inflation, has real problems with people's debts. Now, the only way to stop people borrowing is to make it too expensive. It's not to tell them that it's bad or tell them they shouldn't do it. How can the central banks preach that when they've kept interest rates so low? It's their job, to make money attractive or not attractive. So as that comes in, then really, I think the euro has no real choice, as we see here. There were people profit taking, and we can, again, when we see perhaps on the daily formation is a bit better, when we see these lows broken here, there's big kind of voids that want to be filled back to these levels in the euro. Sorry, Sam, do you want to say something?
Steve, yeah, we're getting just a few questions coming in. Some of our listeners are sort of just quite new to trading. And
okay.
They're looking at your screens and they're wondering, what's this line and what's that line? Is it possible to take a few minutes just to take a step back and just explain how you've got your screen set up? Obviously, the more experienced will understand that we're looking at Fibonacci levels here, but just for the benefit of those that are not Fibonacci traders, if you could just take a couple of minutes to give us a very brief explanation of how you set your screens up, that would help people understand what they're looking at.
No problem at all, Simon. Yeah, okay, so if you're starting with a basic chart, let's take something I don't trade very often, if at all, WTI, so just an oil product. Now, if you're looking at a standard MT4 chart, which is a good way, if you're a trader, to understand the technical side of trading, to understand how markets move, this is what you look at. So this is an hourly chart. You can zoom in, have a good look at your bars here and think, okay, right, well, oil, that's an interesting market, isn't it? Doesn't it have to go up? Isn't it a scarce commodity that's going to run out eventually? Yes, well, if you're looking at something, for direction and looking for something to kind of, how movement and how the past has moved and how that will affect future movement, this is how you do it. So if this is an hourly time frame, maybe go to a daily time frame and say, well, oil's gone from the high to the low here, low to the high here. So if I want to buy oil, so I think it's going to go to, wherever, $60, or I think it's going to go down to, to $40. How do I do that? How do I find value? Well, Fibonacci is one of the ways of doing that. You're looking at the past movement to predict future movement. So in this very crude scenario, I'd say if I'm looking at a daily chart, well, oil hasn't made a new high yet or a new low. So I'm going to take Fibonacci retracement from the high point here. Doesn't matter what it is, it's still, back in May, it's still relevant, to the low here in June. So we're saying that the market now hasn't made a new high, hasn't made a new low. So what I'm trying to figure out is, what's it more likely to do? Well, your Fibonacci retracements are showing that if the market's gone from a high to a low, 80% of the time, that's a strong directional move, it will retrace to 50%. So the market gets through here, 23.6, through here, 38.2, and lo and behold, it gets to the 50%. So it gets to the 50%, it doesn't make a new high yet, but it hasn't made a new low yet. So for me, if it hasn't made a new low, yeah, and it's bounced and held above the 50%, it's more likely to make a new high. So I'd say based upon this, failing, yeah, to hold below the 50% significantly, even though we get below it for a few days here, it's more likely that oil in the short term is going to make a new high, a new low. So you've got 1,360 pips, and if you want to make that, you've got 2,500 pip stop. So that's it. It's simple. If you think oil's going to make a new high, you buy it where you see value, so where it's low intraday, and then you buy it to here, or will you stop here, or you sell it to here, will you stop here, opposite way around. But you've got an idea of where the market's been, where it's going, so you're really essentially pivoting around this 50%, looking for support or resistance, yeah, on the levels around the 50%, hoping, or again predicting, because we don't really like to hope in trading, that based upon that previous movement, yeah, ranging between $52 and $42, that 47 is a pivot. So the chances are, now it's held above that 50% at the 61.8, chances are it's going to get to 52 before it gets back to 47 or 42. So that in its crudest sense of how you would draw a Fibonacci on the day. So obviously that's a chart. And back on the hourlies, this is where the kind of crux of trading is done for me. So what I've done is I've created iView charts, which is how I view the charts, and just have it like this. So all of a sudden, instead of green meaningless candles and kind of Fibonacci's are a little bit hard to predict, I'm looking at oil thinking, right, well, the same question. Oil's gone up, but in my hourly, let's go back to probably the daily's better. I'll just do
okay, there's no absolutes, Steve, is there, in this, in terms of finding the absolute correct way to start your Fibonacci, and it's something that you learn through practice. And
well, the trouble with Fibonacci is once people like things that are absolutely set in stone, and people like things like RSI. So if it's above 70, then the market's overbought. If it's below 30, it's oversold. And that's a number. I can understand that. The thing with Fibonacci is that you have to put it into a context that you understand. So when I use that example in oil, I just used a relatively close high and low that hadn't been broken, and that is a good jumping off point. If you've got to be more scientific about it, well then that's when Fibonacci becomes more difficult. People don't like Fibonacci, it's the same as the Elliott wave, because you have to be the person that puts it onto the screen. You have to decide where it starts and where it ends. And that's where people get a little bit frightened, because why would they trust it? And the reason why I did iView charts is because I've used Fibonacci for 15 years. So 15 years, I've got it down to a point where if I get the right entry and exit point, as in where I'm drawing the Fibonacci's to and from, then I've got an 80% chance of finding that 50% pivot and making some money to the right of the chart. So 80% is as good as you'll ever get in trading. That's all you will ever get, an 80% signal. So realistically, what I'm trying to say is, with iView charts, is I've tried to mirror that as much as I can. And when you draw this template on, just by clicking, it will change the normal MT4 screen into this, and it will put the Fibonacci into that sequence and draw it for you to the 80% edge that I know that I've got. Now, 80% obviously leaves 20% of that unknown, but I would always like to work around a framework. But I know personally it's worked for me 80% of the time. And even if that drops down to 70 or 60, I still know that if I'm looking at the overall trend, I'm looking at the correlations, looking at the market that I want, that I'll be able to make, a few pips around these Fibonacci lines, especially this all-important 50. So you see on the hourly chart, again, I'm not bullish or bearish oil. I don't care. So I'm just looking for a few pips. So this 50%, I'd be getting involved, selling as we come back into the Bollinger Band. And as we see, the market rejects the 50%. We have a 42, 40, 50 pick move. Now, as you've known, I've never been, overly kind of, bored about these things, but I will only take 10, 15, 20 pips out of a move. I don't want any more than that. I'm an intraday short-term trader. So if I can get 20 pips out of a 50 pip move here, I'm happy. And that lasts me 20 minutes. That's absolutely fine. Then the market consolidates, takes a lot more time then to sell back down to where it was. So again, we've got a bouncing point. We either break these fibs and get down to the lower fibs, or we get back to the 50% and oil continues higher. So it's really, really difficult to understand where you should draw your fibs. And that's, again, when you look at these lines here, they're all Fibonacci lines. So ignore the kind of blue dotted lines. They're just daily, weekly, monthly points of interest. They're just points where the market's been before in the past. The Fibonacci is essentially 50% pivot. Yeah. When it gets above it and the red lines, you want to sell it, get back to the 50%, and it'll get to the greens. So here we are, 50% goes through all the green lines. Where does it get to? The previous points of interest. 50% rejects it. You could buy back the levels. Close above the 50%, goes higher. 50% breaks, green levels. Support, where's it going to get back to? Euro, if it's an uptrend, probably the 50%. So it's just giving you an idea of, because these lines are pre-drawn for you, where the Fibonacci's have worked in the past. Okay, they scan the market to the left to the most logical point where the most people would draw a Fibonacci. And some other little clever indicators in there as well to make it a little bit sharper. But then that builds into the self-fulfilling prophecy, because everybody's heard of Fibonacci. Everybody knows about Fibonacci, hopefully, if you're a trader. It happens in nature. Fibonacci is the reason why your foot's the same size as your forearm. I mean, stick your foot on your forearm now. Yeah, that's Fibonacci. So these things are not new. They've been around for 1,000 years. So what I've done is just allow a clever system to scan back to the left of the chart, pick out the most logical points of Fibonacci, and draw it on. So you get less noise. I mean, if you're trying to trade the euro, how much noise do you want? All of a sudden, you're trading the Fed, bang, bang, bang. What, another interest rate of 3 next year? That euro is going to get smashed. So euro does get smashed, but it's been in a big uptrend. So maybe when it gets down to these lower levels, we have a little cheeky buy. Yeah, a little bounce here from the low. Market consolidates, a little bit of a longer term. Yeah, back to the 50%. I'm not bothered about being right. I can tell you that the pound's going to go up, which it is. I can tell you things like the New Zealand dollar will go down, because it will, because that's a longer term view. If you're trying to make money like you were off the Fed yesterday, well, you could have sold the euro. Yeah, I mean, you've got a little bit of a squeeze here, but you could have got it out here, 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 or here, because all these lines are already there for you. Because it knows where it's been in the past and how it's got there, and knows how it's going to move in the future. Remember, all we're trying to figure out is what's happening to the right of the screen. All this is the past now, but it has significance. People have made money, lost money. Yeah, people have probably lost a shirt in these moves. Yeah, but markets have gone up, markets gone down. So they've moved in a way that we understand. We're going to use it in the future. So these points, especially this 50%, is what we need to concentrate on. Euro continues that bullish move from this point, goes up 790 pips, or it breaks a new low, yeah, which is about 54 pips away, 51 pips away, and gets down to here. Yeah, so for me, that's where you put your stop. So if you're looking for euro to go higher, you've got 767 pip stop to make yourself 779, down thereabouts. How difficult do you want to make it? If you're a short-term trader, go into your 15 minutes. And again, this is a Fibonacci drawn on the 15 minutes. So right now, we're holding above the 50%. So these points are levels where the market might break. So again, it's looking at the market on the time frame you want to do. If you want to take a longer-term view and hold, that's absolutely your prerogative. If you want to, hold the euro for days, weeks, and months, that's fine. If you want to make money trading, then all you have to do is hold trades for 10, 15, 20 pips around key levels, but trade proper size. Trade £20 a point, £50 a point, £100 a point. I trade average positions, so I'll trade up to 1,000, maybe more, a point. So, if you're trading £1 a point and made 20 pips, would you be bothered if you were £20 on side, 21, 18, 16, 15, 12? You won't be bothered. Hold on, how about you £20,000 on side? 18, 17, 16, 15. Oh no, I'll take the 20, thanks. I don't want to get down to £12,000. Certainly don't want to go below 10. Got to make your trades count for you. And with all the rules, the MiFID that are coming in, they want people to trade professionally. Well, that's how you trade professionally. Nobody's gone out there and made a fortune or a living from trading £1 a point. You might as well not bother. So again, there we go. When you look at the kind of screens in an overall position, what I'm looking for is correlations. And I started to tell you about these correlations right at the beginning, that US dollar, Japanese yen, is US interest rates, essentially. So dollar strength relates to interest rates. The euro and the pound relate to Brexit. And again, you're going to see a lot more growth in the pound because Mark Carney's already lied to the world, or lied to everybody, and said that interest rates won't go up till 2019. And now we're talking about November. Well, what's going to happen to, the pound might be a bit sluggish against the dollar, because obviously the dollar's off, already raising its interest rates. But if you look at something like the New Zealand dollar, where I'm currently am right now, then you can see a different story. So again, pound against New Zealand dollar, look at the monthly chart, seen big sells, big sells, yeah, away from the highs, what were we at 2.5, and then the market obviously thought that New Zealand was going to do better than the UK. They will have Brexit, big sell-off, market consolidates. But then we think about it, New Zealand versus the UK. New Zealand, 4.8 million people, 1.75% interest rates. Interest rates might go up by 0.25% sometime in the next 5 years. Pound seems a bit low. All of a sudden start talking about the pound putting, the UK putting interest rates up. Well, all that Brexit becomes a target. So Brexit, is it going to get solved one way or another? Yes. Is it going to be negative? Potentially. Is it going to be negative forever? No. Are 4.8 million people going to be able to outperform the GDP of London? No. So what do long-term investors do? Short-term investors look for points to break. So the people who are short want to get out. So we break this level here, 189. Then we've got all this area here to get back. And again, if you want to do something like a Fibonacci, probably do it on the weeklies. So probably from the last significant move from here to here, you draw your Fibonacci, the 50% is about, it's just below 2. So it's pretty obvious in kind of my eyes what's going to happen. 50% on this is here. So yeah, 93. 193. So that'd be my initial target to get above, and then maybe we get to the 50% of this move from here to here. Because we haven't made a new low now. No chance that Mark Carney can really get away with not putting interest rates up. So this big drop caused by otherworldly events. When we hadn't heard about Donald Trump, well, we had obviously, but he wasn't president, and there's nothing with Kim Jong-il and all this stuff, and Kim Jong-un, whatever it's called, blah, 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 politics. And as that kind of fades out of memory, and we start to think about the future and to the right of the screen and where the world's going to be, well, Brexit, the bill's going to get paid. We're going to continue to trade with the European Union and the rest of the world. Everyone forgets about Brexit, what it was all fighting for, and the pound continues its merry way because it's going to be more valuable in the long term than the New Zealand dollar, because it's just numbers, bums on seats. So that's kind of an interesting way of looking at things. And, again, we see certainly the pound against the dollar has shot up, because we know that the pound has lost a lot of value against the dollar. But it's that kind of weird battle. We're not really in battle with the US. We're an ally. And there's no way that the pound can ever take over the mantle of the US as the world's, currency of choice. But in the short term, because it's been battered, any inkling of a change in interest rates in the UK, it's going to make it more valuable. People are going to speculate that it's going to go up. So again, gets bid up on the UK, Fed come out, bash it back down. But really for me, because we've lost so much ground against the dollar, that there's still value to be had. I mean, when we looked at the euro had this kind of picture. So all again, the euro was down here after this kind of consolidation, but it's now up here. Well, the pound's just the opposite, down here. So you flip this chart on its head, the pound's just doing the opposite to what the euro's done. So people have voted for the euro, that's gone up. They voted against the pound, it's gone down. But nothing lasts forever. Nothing lasts forever in trading. Everything's in cycles. So this has been a down cycle for a considerable amount of time. There will be an up cycle. So for me, when you hear things like interest rates going up, you hear things that, the UK is sticking with Brexit. And it's, it's not necessarily positive, but we're going to be in control a lot more. So I think net over the next 5-10 years, it's going to be good. So as the pound has fallen out of grace with the dollar, there will be a time it comes back, and maybe this is the bottom here. Okay, so look at the same kind of situation with the New Zealand dollar And the US dollar, well, again, New Zealand dollar was falling as interest rates are going up, had a little bit of a peak and a bit of a stretch up, again, maybe a short-term bit of speculation on being a safe haven currency in a very politically turmoiled world. But then again, big spike up here. So the market really, for me, we get back to the 38.2, 23.6 to 0.0, and I can easily see, I don't think there's any point of an interest rate anytime soon in the New Zealand calendar, and if it is, it'll be very, very slow and gradual, as we'll like with the UK. But as the US continues, we're only going to see dollar strength for the next couple of years as speculation kicks in. So you've got all your pivot points here to potentially get involved in. So on the hourly charts, again, you're either selling high or you're buying low. So if you're selling high, you've already had it. You want to buy low, 38.2 or 23.6 down here. So again, these are the correlations you need to look at. You need to be looking at charts that have some correlation, that have some way of, if one's moving out of kilter, then it might give you an indication that something else will happen. So New Zealand dollar being low could be an indication that people are ready, to buy that up. So dollar might then go down. But really, that's a bit of a stretch when you're talking about New Zealand pound and dollar. Really, when you go back to iView charts, it's set up this way because this is what all traders look at. All traders that know what they're doing. You have the DAX, gold, S&P, euro dollar, dollar yen, pound, US dollar, UK 100, and the Swiss market here I keep just a bit of a filler, a bit of a risk on, risk off. It's a good indication if European stocks are going to kind of move one way or another quickly. So in times of trouble, times of unease, then gold goes up. So gold's going down because we're not worried about Kim Jong-il, apparently, or Kim Jong-un, whatever it's called. So market's going down. So this is also related to the dollar. So as dollar strength goes up, as the dollar gets more expensive, gold gets more expensive, so people dump gold. So these are inversely correlated. This goes up, this goes down. So when this goes down, these are positively correlated, well, inversely correlated for stocks in this respect. So as gold goes down, people are going brisk off. That means people will buy lows in stocks. So as we've come down, people have continued to sell gold, but they've bought the lows in the stocks because there's no bad news for stocks. Stocks keep going up. Okay, so these are the correlations you want to look at. So as the pound goes down, the FTSE will go up. The FTSE goes up. Yeah, the pound will go down. So these are the kind of correlations you're trying to get a basic picture of the major currency pairs, the major indices, and risk off, as in the SMI Swiss stock market and gold. So again, it's understanding correlations, understanding things like non-farm payrolls. A good non-farm payroll, gold goes down because it's good news, stocks go up. So again, looking at the markets continuously around these 50% hourly pivots and these points of interest and these correlated markets, directly and indirectly, and you start to get a balanced picture of what the world markets are trying to achieve. And you can go real deep into these things, and especially when you're trading currencies and go into the currency coefficients, how related, the dollar yen is to the pound yen. And, you can set your currencies up however you like. And there are certainly bits of software and tables out there where you can see the coefficients working in harmony. And that just means that, if somebody buys one currency pair, they're very, very likely to buy another one that's like it, or very, very likely to sell another one that's very unlike it. And that's, again, trying to figure out where you stand in the markets, because people get frustrated trading the majors because you have a few good trades and then, you see a big spike over the Fed or non-farm payrolls and you think you don't understand it anymore. The whole point about trading is that people expect it to be a level playing field and to be fair. Well, it isn't. It's the people with the biggest pockets always win. And the biggest killer for new traders and certainly kind of aggressive traders is time. How many times have you looked at a chart, and thought, that's exactly what the market's going to do, and you do it, and it doesn't do it. And you think, I wonder why that didn't happen. And then as soon as you go away from your screen, it does exactly what you want. And then you try and do it, and it does the opposite. This is how markets work. They know exactly what you know. Everything I teach, everything I say, everything you read on the internet, every course you're going to listen to today, every expert that you're going to listen to today, the markets know all that. It knows everything. So its main purpose, its main job out there is to make you think you're wrong in the short term. So if you can get out of feeling that fear and dealing with that short-term pain, And trading's fairly simple. But again, it takes a long time to learn these things.
Steve, you make it sound very simple. It's fantastic. Getting some great feedback coming in. Catherine says, brilliant webinar, such a treat. Thank you for that. One or two pairs people are asking for. I wonder if you could let us have a look at the pound Japanese yen and maybe also any thoughts on the Dow, on the progress of the Dow, any signs of it slowing down in your opinion?
Okay. Any other currencies apart from the pound?
The Australian and New Zealand dollar pair.
Yeah.
Yeah.
Sorry, I'm a little bit rusty. It's been a couple of long months. Sorry. I'm actually trying to do this on a laptop in the back of a camper van in the middle of nowhere.
I can imagine you've been doing the adventuring trader.
Absolutely. When I say camper van, don't think of me in some little hobbled out VW thing. I had a 6-man camper van that could, fit a family of 10 in, with just me, my wife, and my dog. So, we were traveling in style.
I'm thinking about Winnebago. Is that more like it with the?
It was like Meet the Fockers. It was one of them.
Okay, I've got it.
Just over 7 meters long. So driving that down Dead Man's Highway after a torrential thunderstorm for 3 days with the road, falling away at the side with no protection. Yeah, pretty interesting stuff. A good way to test your marriage, your first year of marriage.
And congratulations, pal, on your anniversary.
Yeah, I know, but yeah, it's the date just came and went, didn't it? So funny how time flies. So yeah, the Australian New Zealand dollar. An interesting one right now. We're going through the elections here in New Zealand, and actually, New Zealand and Australia are a lot more tied than I thought. If you get an Australian passport, you also get a New Zealand passport. So it's a lot more. They feel a lot more isolated down here, so they are a lot more connected to each other than people may have thought. So the elections will have an effect on the Aussie dollar versus New Zealand dollar. New Zealand, again, is a relatively small population for 849 million people. And Australia, it has this amazing ability, doesn't it, to just keep generating money and growth. I think we're 24 years without a recession. So it's kind of one of these things, isn't it? It's long-term, something's got to give. So when you're looking at the kind of charts on this, I mean, it's very difficult for me to kind of come in and give any massive, insights to the economy or to anything kind of uber sensible, to why you should kind of build your trading strategies around this. But essentially, the Aussie versus New Zealand dollar. I mean, I think the short-term kind of risks are all about this election. That if the Labour Party get in, they've talked about taxing, etc., etc., etc. It's a bit of a desperate plea, like it was in the UK. So the latest poll was down that the Conservatives or National Party have got a 9-point lead. I actually saw the guy in the pub. Funnily enough, in the marina last week, he just wandered into to one of the pubs I was in when I was having a drink and gave a little speech. So they're pretty chilled out, pretty relaxed down here, but it looks like status quo. So I'd say that the Aussie is likely to fall a little bit further against the New Zealand dollar before it bounces. So again, you've got your 50% fib. What did I say? It's just amazing how the markets are drawn to these levels, and that's monthly. So if you draw that in, I would say that this is the first place to test 108.164. So go back to the dailies. Again, you've got a nice option to sell down to this level, maybe a break, buy low, or buy it back. But on the kind of hourly charts, yeah, I mean, it's right there. It's right there for the taking, isn't it? I mean, I would say that the Aussie, in the short term, if the election's going to go the way that the polls want, we saw that big spike when the poll came out yesterday, where the New Zealand dollar significantly rallied. So if that is going to be the case and the National Party are going to continue, then I would say the Aussie weakening slightly quicker against the New Zealand dollar before bouncing, because it's a bigger country, bigger economy, and people buy the Aussie over the New Zealand dollar all day long. But then remember, the flip side is that with 24 years of no recession, everything's great in Australia, then everything good comes to an end. So maybe longer term, as in 6 months, a year, or whatever, there could be a possibility that that Aussie it does considerably weaken against the New Zealand dollar. But because it's so closely tied, it is a tough one to trade. So again, not being a cop out there, I'm not saying I don't know, but I'm saying that that's your pivot, and it's more likely that there's going to be Aussie weakness in the short, medium term than any kind of significant bounce. Pound versus Japanese yen. I'm a buyer of the pound. I'm significantly long the pound, and have been for some time. And for all the arguments I've always said, I knew Carney would have to buckle on interest rates. And anyone who's listened to my webinars or Simon's webinars over the last years knows that I've said this. Now, always said I'd sell the euro high, but I've never had a long-term view on the euro. But I certainly have a long-term view on the pound. And again, every time we talk about interest rates, then this market's going to keep bouncing. Again, a very, very basic Fibonacci from the highs to the lows. Then you're looking at the 50% is still a major target here. We're hitting new highs all the time. So 159, 160, I think that's an absolute shoo-in. Nothing coming out of Japan that's given me any kind of confidence. So Theresa May, give her the hardest job in history, haven't we, the old girl? We all voted for Brexit and then, cut off her hands to do anything with it. So it's going to be interesting times. But as always, the empire, however you look at, however strong, weak, or whatever it is, we're still a major global fighting force and probably one of the only sensible voices out there still in the world. So the pound's going nowhere. I don't think we're going to see a rapid rise in the pound. It certainly has the ability to flash into these higher points and then come down. But I do see a slow, steady grind as we get Brexit behind us and we just realise that it's business as usual for the UK. So 159, 160, I think really is a shoo-in in the short term for the dollar against the pound against the yen. I cannot see any reason why the pound will start to drop now. I mean, again, look at this beautiful kind of movement. Every bottom, been bought up, rejections, bought back up. So yeah, very very bullish the pound. And again, it's not just because I have a lot of them. It's just or a lot invested in it. It's just because that is the logical thing for me. Carney got it wrong. Brexit happened. He was wrong on Brexit to cut interest rates after that. There was no need to do that. So we're in a position where people are over indebted. People are getting squeezed with inflation. So unfortunately, we're going to have to bite the bullet and we're going to have to feel some pain. And as I said, it will be the middle classes and the young workers and the newly onto the property ladder who are going to have to pay for it, unfortunately. But that's just the way it goes, it seems, in these modern times. So
we're just about 10 to 10 here now. One or two questions have come in about the MT4, the signals, your indicators, how the highs and lows are automatically being drawn.
Yeah.
Could you tell people a little bit, because this is iView charts. This is what you use. This is your setups. Could you explain to people how they can get this and how it works?
Yeah, absolutely. I mean, iView chart's been around for a long time. It's been around for about 5 years now, and really, because I've done so many of these webinars, as you know, Simon, I've done close to probably 1,800 webinars now. And I got, not sick and tired, but I got asked the same question so many times. Steve, what time frames do you use? Steve, what indicators do you use? Steve, what candlesticks do you use? Etc. 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 I decided to approach some guys in California that are a lot smarter than me and got them to make my ideas into a system. So. At the end of the day, what this does is it just puts everything into an easy to explain. And when I say easy, there's nothing easy in trading. What the difficult part of trading was for me personally, and if you read my book and you read, some of the webinars and listen to webinars, it's all about understanding how you interact with the markets. There's no one out there selling a system that will make you a good trader. And that's why I give iView charts away for free, because I'm not looking to make money from it. If you look at the markets in a way you understand, you will get the confidence. If you see these Fibonacci's, not 50%, the green and red lines enough, then you'll know what to do instinctively. And that's, again, with the correlations is how you make money in the markets. Doing the same thing over and over again, yeah, and then cutting out the bad mistakes. So if you want iView charts, the UK offer, so I'm global now, the UK offer is as simple as this. Open an IntraDrader account, a live account, put £5,000 in and above, and you will get iView charts for free, and you'll get access to speak to me. I'm going to start doing some more newsletters, some interesting kind of technical and fundamental insights, because I've got my rig and I've got some time now. So yeah, it's as simple as that. put 5 grand into an InterTrader account, go through steveruffley.com, click open an account, or send me an email and do it. You get iView charts, you get my mentoring. If you want to be serious about trading, I'm not gonna lie. I'm not gonna bullshit you, because I'm not that kind of person. If you want to make decent money in the markets, especially with the MiFID II things coming in, regulations, you're going to have to put 25 grand in. All my really successful traders have 6 figures. I know that scares a lot of people, but that's the reality. I would say 5 grand gets you, a foot in the door. 25 grand, you can make a living from that trading.
Indeed, money makes money. 1 or 2 questions just in the last couple of minutes for you, please. What is the more safe way to trade? Day trading or swing trading, holding a position for 2 to 10 days? Okay, where do you sit on?
They're 2 different things. I mean, the more time you're exposed into the markets, the more risk you have. So if you trade for 2 seconds, 2 minutes, then you have obviously less risk, but then you can make less money. If you want to do a swing trade, you can swing trade in an hour, you can swing trade on a daily formation. Again, 2 days, you have 2 days of risk, 10 days, you have 10 days of risk. You can make more money by holding for 10 days on smaller size, because obviously, you're smaller size, smaller risk, longer time to run. You can make more money intraday trading with bigger size, with less risk. Yeah, it's just scary. So for me, the less time you're involved in the markets, naturally, the less risk you take. Again, it all goes down to that account size. If you're trading £1 a point, you have to wait 10 days to make any money. If you're trading £100 a point, you have to wait a matter of seconds.
Okay. What about stocks, Steve? Do you look at individual stocks at all, or purely indices?
I'm starting to think about it. I'm only starting to think about it because UK rates are going up. So UK rates are going up. This was my thought process last night when I was thinking about it, because I'm just new to New Zealand, so I'm looking for a little runaround, just a little 4.7 litre Maserati. And what I was looking at is you could pick up like a BMW, 3 years old, for next to nothing. And I was thinking, that's quite a nice motor. Not for me personally, but it's a nice car. And this is the kind of thing I'm thinking about shorting, kind of mid-end, kind of luxury type, or little less than luxury. I don't want to kind of do a disservice to BMW here, but yeah, I'm looking at shorting BMW shares. I think they're going to be a big casualty of this rate increase. Because remember, the big thing now that we're all frightened about in America is a subprime car loan. So everyone's buying things on cheap credit, and as the the interest rates go up, people are going to default. So the market's going to get even more flooded. So yeah, I don't look necessarily at individual shares, but not a tip, because I don't do tips and I don't do long term. But I will be looking at some point in the future to shorting BMW.
Interesting. Has the travel around the other side of the world sort of given you a different perspective?
Yeah, I hate traveling.
Yeah, okay.
Never going anywhere ever again. And I did it first class, mate. I did it first class, and I tell you what, it was. I'll tell you some stories another time. I had the most crazy journey ever. It involved porn stars running around naked in first class, to things in Hong Kong I can't even tell you about over a live broadcast. So we'll have to speak about that some other time.
Okay, so Steve, a final question, and a good question to finish on, if you can, just in the last sort of 30 seconds. Yeah. Do you have a view on Bitcoin?
Yeah, it's unregulated, and it's basically China have stopped all the kind of trading of Bitcoin. So it will be when the Morgan Stanleys, I think they bought the franchise. When they regulate it, then cryptocurrency will be a real thing. Until that, it's something you're punting, and you might as well have a punt on the horses. It's going to fluctuate up and down, and it will have value to somebody, but it's not something you can sensibly invest in. It's a punt.
Fantastic. Okay, we'll leave it there. Steve, thank you very much indeed for joining us, and put your website details are in the chat box there for anybody that would like to contact Steve. As he says, there are mentoring services available for various account sizes. So go to the website there, drop your email in, and Steve or one of his support staff will get in touch with you, and you can take it from there. Or if you want to drop me an email, I can put you directly in touch as well. Steve Ruffley from steveruffley.com, thank you for joining us. It's been good to catch up with you, and I will the presenter role back from you now.
All right, good luck, mate. Take it easy. Bye bye.
Bye bye for now.